Good morning, ladies and gentlemen. This is Clueless 8 Trading. Frank, it's a quick pre-market AM report for Monday, a beautiful Monday, May 23rd, 2016. It's been a very, very busy couple of weeks, to say the least, both in the markets as well as in our personal lives. I do apologize that the comprehensive end of the day, end of week report, the EOW report, could not be presented over the weekend. I will, however, strive to do that by this evening. Anyway, what's very important is that a substantial amount of content, trade alerts, breaking news analysis, charts specifically have been presented for the benefit of members and free trial subscribers. And it is good to see that despite the intense volatility that we are incurring in the market, in between this large consolidation channel that I've shown for many weeks now, has helped and benefited tactical, focused, and disciplined traders, and we have had some phenomenal returns on an aggregate basis across the board. Individual stocks are not always held hostage to what the overall markets are doing. In the background, you're seeing a live real-time futures chart, the S&P 500 index futures, known as the E-minis, and I have strived to be involved and given tactical help in good, bad, and ugly environments every single day. That has to be appreciated by every single member and free trial subscriber. And I know that many of you have benefited tremendously from the tactical trades that we have executed. Keep in mind that this market is all about tactical trading. Yes, when we look back at the overall picture, we can see what's going on. We can see the highs of, the market back in May of 2015, right there in the 2130 range, 2134 to be exact on the S&P. That's roughly 2127 here on the E-minis. We can see through every single gyration in the market, structured volatility, as I call it, and I have shown it and validated my point almost in every instance with my precision forecasts. You can clearly see that we are that there is a very defined pattern to what is going on. Now, when we're trading on a daily basis or on a weekly basis, those patterns are not always visible. To me, they are, but to a lot of traders and members who are not that focused on charts and just simply focus on prices, which I think is not the right thing to do in this type of volatile environments because there are so many false breakouts and false breakdowns. But we can clearly see what's going on here. Now, the most important thing to focus on, regardless of what stocks you're trading, okay, but if you want to get an overall view on the market, is this particular consolidation channel, period. Okay, and this consolidation channel is what holds the key to what is going to happen as we move forward, or even on a daily basis. So just to go back and remind people, bear with me one second. It's extremely important for people to remember this because that's the key to this business. I'm trying to get that the drawing tool. I don't know where it disappeared. Let me see here. We'll forget the drawing tool. Let me just show you. So here we have a very large double bottom formation. This is from last August and September. Many of you might have forgotten, but those were absolutely horrific times, both on the long side and the short side, and we managed to navigate that reasonably successfully. In fact, on the rebound, it was navigated very precisely, and many of you did extremely well listening to my precision guidance on that part. So we had this big flash crash that broke down in August, which I think, in my opinion, we are going to still see a big thump in the market in the months of August and September and early October before I think we recover as we get into the year. Remember, the election is looming in November, and there's going to be huge uncertainty and doubt as to what the markets are going to be doing. Saying all that, the big flash crash, the pull up, the heavy volatility, then another higher low, then this big move up. Then we went through a consolidation. I'm sorry, a volatility range, I'd like to call it, in between 1996 or so on the E-minis. That's roughly about 2,000 on the S&P, and on the upper end here at the 2100 level. So roughly about 100 S&P points, which translates into about 700 Dow points that that the market basically floated in. Extremely unnerving for solo traders who have no idea what the heck's going on. But for us here, can go back and listen to those video casts and review the charts from that time. You can see here that there was a significant amount of money to be made. That is exactly what's going on right now. Okay, now somebody sits here and tells me that we're going to go back and retest 1800. I'll say, you know what, might be right. Okay, I still have that as one of my scenarios. All right, but that's probably not going to happen immediately. That's something that could very possibly happen by fall of this year, by September of this year. Okay, so keep that in mind. Markets don't make it easy. Ever make it easy. We all know that. Well, on the short side, you know what happens. You know, the market looks like it's going to have a breakdown. It holds all these levels that I keep on pinpointing. And then you get these humongous rallies that decimate dogmatic shorts. All right. And those S&P puts or the RUT puts and stuff just disappear into thin air. Zero. And then we get these attempted breakouts within this channel. As you can see, it's very defined. So now I'm going to, move into this. But before that, I'd like to point out that this 1800 level is an extremely powerful solid floor. And we can see that here again, back on January 20th, and then again on February 11th, right? And then where we are. Humongous rally. Again, looking at pattern symmetry, this rally is the length of this rally is significantly longer than what happened here. But then here we were holding about 1900 or 1860, and we had slipped down to 1800 at that level, roughly about another 500 points lower at this point. So let's focus on what's going on right now, because that's really what matters to us, right? So what we have here is a consolidation channel. We have an uptrend line, which coincides somewhere around 2076, roughly around 2080 or so, or 2080 and change, 2082 maybe, on the S&P 500. And as we zoom in closer, we can see that the market right now is attempting in between this very defined channel that it's traveling in, channel number 1, and the lower channel, which where it's at 2008, which on the E-minis, that's roughly about 2014 on the S&P 500. The key in the sand, which everyone, I mean, the line in the sand that it seems like everyone is focused on is 2020. But the reality is it's actually 2014. That's 2007 on the E-minis, roughly 2014 on the S&P 500. That's the real line in the sand, okay? This touch point here, touch point there, and then this touch point here. Now, is it possible that we just suddenly slip and get down there? Hey, anything is possible. We've seen 300-point moves down and 300-point moves up in a single day. So there's nothing that tells me that it can't happen. However, let's see what's in hand right now. So at this point, the market is attempting to cross over this red line here, this red line, which is the 50-day moving average. And in the case of the E-minis, which I track very closely for trading purposes, is 2055. Over the 2055 level on the E-minis, if there is a burst up and a short squeeze, then we attempt to hit this orange line here, this one, which happens to be the upper end of the channel. It fits in, the confluence of these lines are perfect, and that's 2063. That translates into roughly 2070 or so on the S&P 500. So if you do simple math here, we closed around 2050, 2052. So another 20 points or so, which means that roughly another 120 Dow points, the market's going to hit a strong wall of resistance. And that happens to be this particular downtrend line or the upper end of this consolidation channel right there. Can't be any clearer than that, okay? Let's keep it simple so your head's open to do the right things on the trading side, okay? Don't get too complicated with charts and stuff, because the reality of this business is that there are great chartists out there. Believe me, I'm clueless. But the bottom line is, I'm clueless with a very with razor sharp vision and night vision, where I can see a lot of stuff happening before they happen. As you all know, I did say, I want to remind everyone that May 20th would be a bullish event, which, because that's the monthly options expiration, and as you can clearly see, it was a massively bullish event for many stocks that we trade in, and I don't need to remind anyone what all these particular stocks did, whether it be Apple, whether it be Netflix, whether it be Amazon, whether it be Priceline, even Google, and then of course the slew of biotech stocks that I'm showing people. So the bottom line is that came right. All right, that came right on the monthly options expiration. Today's Monday. It's going to be a bunch of technical resets that are going to take place, because all kinds of technical bookkeeping. In the old days, it was bookkeeping. Now it's technical resets, as the machines basically reset the events of Friday, monthly OPEX. All right. Don't ask me to get into it too much, but expect some structured random volatility. If that makes any sense. It's almost like an oxymoron. So going back to it, the upper end of the channel, I clearly identify as around 2070 S&P 500, 2063 or so on the E-minis. On the bottom end of the channel is 2023 or 2022, which translates into 2030 on the S&P 500. So we're traveling a band between 2030 and 2070. If we break out of here, in my opinion, the max move before we hit another big wall is a retest of the underbelly of this uptrend line from 1800. This is one of the uptrend lines. You can draw multiple uptrend lines, touching base here. I can show you another one, which can go like this. Now, the way I draw these lines is I look for inflection points where the market either turned or broke. All right, it's really as simple as that. Or if you can do that too. So if you look at this one, this was the point where the market had a large reversal candle, and then it followed through, and then another retest which didn't hold, and it fell. So if I draw this line here, you're looking at the upper end of the Bollinger. It's funny how these how these lines kind of intersect each other, right? This white band you're looking at is basically the Bollinger Bands. So the Bollinger Band on the upside coincides with this uptrend line. Let's call it U1, this one, okay? All the way again from the same origination point, that's 1800 on the 1800 or 1807 on the S&P 500, right down here. So that one's 2116. So that would be a hugely bullish event if the market can get up to 2119, 2120, 2125 on the S&P 500. I'm not looking into that right now. I'm focusing on what's happening short term, because the volatility is intense, and I need to basically be comfortable with profits that come with 10 to 15, 20 point moves on the S&P 500, both up and down, which translate into 200 to 300% on the weekly calls and puts, as you very well know. So saying all that, you have you have this level to conquer, and at that point you should see some selling, because if you look back at it, every single time we hit the upper end of this consolidation channel, the markets basically pull back. Here it looked like a big fat breakout. Look at that huge candle, but look what happened. This line was drawn well before that, but the next day you get this big sell-off candle. I mean, big, almost a bearish engulfing. Then the next day, a pullback, retest on this red line here, which is the 50-day moving average again, and then a pull up. But all moving within this particular downtrending. I mean, this is a consolidation channel, so it's downtrending, obviously downtrending channel, if you want to look at it that way. So bears will tell you that, look, 2020 is just a matter of time, and it's going to happen sooner than later, and then we'll break down. And of course, we have the lower Bollinger to contend with, which is 2000 E-mini, translates into 2006 or 2007 on the S&P 500. And then we have other levels to look at. I'm not going to get into that right now. So focus on this large Bollinger thing from a wide trading perspective. And it's basically all, trading ranges, range trading. Of 2000 on the E-minis, on the upper end, it's 2117. And in between, focus on the consolidation channel, which I keep on talking about, keep on showing, and focus on the moving averages, which we are at right now. If we break out over the 2056 level or so on the E-minis, then we're going to attack 2063. Bottom line is, classic technical analysis says that we need to go over the 50-day moving average. Okay, so we are right there, and that's exactly what the market pulled back on Friday. No magic. That's just the way it is. We'll zoom in a little bit more so you all can see it. You can see that right there. We hit the moving average, the 50-day moving average, and we pull back. Now, the other thing to keep in mind, and which I need to pull back a little bit to show you all in perspective, let's go back to the daily, is look at the trajectory and the slope of the moving averages. So far, they're starting to flatten out. The 34 and the 50 are starting to flatten out, but they're still rising. They're still rising. And standard deviation is zero almost because it's touching the 50-day moving average. So in other words, the distance traveled from the 34 and the 50-day moving average, which are the highways that basically what the market should travel in. The more you deviate, you get that's known as standard deviation, then you're going to reverse to the mean. And that's exactly what happened. Here people got real excited and stuff, but look at the standard deviation from the 50 and the 34. It was rather wide. So what did it do? It came back and retested it, slipped below that, held it, and now is basically hugging it and moving along. So this is telling you that the massive short position still in the market, the large amount of cash, and I've posted some very important articles on that on the Twitter feed, the bearishness, the massive amount of cash sitting on the sidelines, the hedge fund outflows due to forced redemptions as hedge fund investors, many of them want their money back or want it in cash. Mutual fund investors completely hating the market, mom and pop non-existent, is keeping the market afloat. In other words, the pressure on the euphoria side of the market, where everyone wants to put money in the market, is really not there. In fact, it's quite the opposite. I believe the Investors Intelligence report showed a negative number on their scale on the amount of interest in the stock market, which is good, which is a contrarian buy signal. Short term, I've explained all the levels here. Big move up would be 2077 or so, retest of the 2076 level, underbelly of this uptrend line number 2, and that would mean 2085 or so. So very defined levels the market's traveling in, and as you can clearly see in a certain day, for example, techs are looking pretty damn good in the morning. This morning, biotechs are reasonably green, but then the switch can be flipped. On a macro global basis, keep in mind that we still have the same risks. We have the China slowdown fears. We have the Fed. Right now, it's all about the Fed. Is the Fed going to raise rates or not? The Fed's pretty much openly seems to have conveyed that they are open to raising rates in June. And overall, when you look at once the noise subsides or dampens, I should say, it's a good thing if the Fed goes out there and raises rates quarter of a percentage point because it's important. Or I don't think they'll go above a quarter of a percentage point or 25 basis points. But the bottom line is that if they do that, that's a good thing. It shows some stability and what they're seeing in the global markets, in the U.S. markets. We are seeing some strong numbers coming out on the U.S. side on inflation, which is a good sign. And that's basically it. So stick to understanding what I'm showing. Look at my charts, look at your own charts, and you're going to do great. We have individual stock picks which are doing fantastic. All right, and despite extreme volatility. But you got to manage your profits. I keep on reminding people, I'm here to help, but I can't run your books, and I will not run your books because that's not my job. Okay, so let me show you another chart, which is very clean. I started using these, and I use them time to time. Okay, whether the high-lows close charts, the stick charts, HLC, or look at these candles. You had a reversal candle, hollow reversal candle. People who know, I've explained this very clearly, that this one showed exactly where we're going to go. Look where we went. We tested this downtrend line here, and now I believe we're going to try to get towards 207. Looking at the internals, which might give us some idea as to what's going on, we are seeing positive divergences, and you can just look to see the stochastics basically, despite that we made a lower low, the stochastics made a higher high. That's a good thing. And if that sequence follows, then we should expect to see a move up. And you can do it like this up here at around the 208.62 level, which translates into, like I said, the 2086 or